Hey everyone, Ken Calcutt here with Cornerstone Financial Management. Happy New Year. It's early 2024. I wanted to give you an update on last year and going into this year. What I want to talk about today are variables that we monitor closely in the market and ultimately point to the deciding factor in what a stock or stock market should be worth is really earnings, corporate earnings to be exact. So corporate earnings is essentially corporate profits, and the variables that we monitor here and how they affect corporate profits, because that largely dictates where the stock market's going to move. What we saw going into 2023, inflation was high. That's now not the case. Going into 2024, inflation is now below 3. The Fed has been clear they want it at 2. So we're in pretty good shape here on inflation. Inflation is no longer a problem that's causing corporate earnings to go down. Interest rate hikes. Interest rates have been going up for the better part of 2 years, trying to get inflation under control. When interest rates go up, that makes it more difficult for corporations to make profits. Their borrowing costs go up, profits go down. This is no longer happening. The Fed signaled last month they are done raising rates. They're likely going to cut rates several times in 2024. I hope that's the case, but we'll have to wait and see. But that is not a negative factor to look at in corporate earnings anymore. The economy, this is one that can very much affect corporate earnings. When we're looking here, we're looking at the health of the economy, namely GDP and unemployment. If GDP is positive, that means our economy is actively growing. If GDP is negative, the economy is slowing down and we're potentially going into recession. As it stands today, the economy is healthy. We're not seeing a recession. We're not seeing signs of a recession, but I still think it's very possible. If we do have a recession in 2024, that will cause corporate earnings to likely come down, and therefore the stock market may come down with it. That's okay. Not every recession is a bad recession. We need recessions in our economic cycle. But I think it's possible for 2024 because the effects of the rate hikes that the Fed's done for the last 2 years have not fully shown up yet. We might see that in 2024. So this is the one we're watching closely. The money supply also affects corporate earnings. The money supply is simply the amount of capital that's in circulation in our system. The Fed actively tried to reduce this number at the beginning of 2023. That didn't work so well, so they kind of had to pause that. When the money supply is decreasing, that hurts corporate profits. When the money supply is steady or increasing, it's a little bit easier for companies to make profits. So we're pretty neutral on this one. So these are main factors I just wanted to share with you that we watch. I feel good about 3 of these: inflation, interest rates, and money supply. I feel like a pretty good going into 2024. The economy, potential recession is the one we're watching. If it shows up, nothing to be too concerned with. It's typically not always a bad recession, but that's what we're watching for. I want to give you peace of mind that we here at Cornerstone are following all of these very closely and making adjustments as needed. If you have any questions at all, feel free to reach out anytime. Thank you.